All right, we should probably get started, I guess. I think it's about time to go. Anybody know where this is? Anybody recognize it?
Pebble Beach.
Pebble Beach, good job. Spyglass, that's the golf course at Spyglass, that's the 7th hole. My son and I just we went down Friday to watch the Utes lose in the Coliseum. And then we rode a Harley up to Monterey on PCH, and this was one of our last pictures of the day. Absolutely gorgeous up there. So, doesn't have anything to do with what we're going to talk about today, other than that I thought it was the most beautiful picture I've ever seen in my life. So,
wow.
So we're going to talk a little bit about syndication. Who knows what it is? Most of you probably do, right? And how many of you ever done one at this point? Anybody tried? You successful with it? Okay, good. One, more than one? Okay, good. So this will be old hat. I'm not going to make this too complicated. You know, the average beginner could probably sit through. We're going to try to dumb it down quite a bit. I don't think it's really that complicated in the first place. The biggest thing is get yourself a really good attorney that understands the syndication laws, so you can stay out of jail. So a little bit about me. I have been in real estate business at least 25 years. Technically, I started when I was 6 because my dad was a builder, and so I used to go to work with Dad. But 25 years out of college, I started with an internship. The Institute of Real Estate Management, IREM, sponsored me, sent me to California for a couple of years, and I worked 15 years for different real estate development or management companies, mostly in California. At one point, I was the regional vice president of a REIT, Real Estate Investment Trust, is a publicly traded company, and they own close to 80,000 multifamily units. I wasn't involved in all of them, but I was involved in a significant portion of them, and you take that plus the stuff that I did with the development company where we acquired about 25,000 units in the 3 years I was with them. And I was involved in a lot of the acquisitions of those two. Anyway, I put a really big number up there, but it just means that I've earned the right to not have any hair on top. So if my kids were here, I make sure to tell them that I had all my hair before my kids were born, and after they were born, it was magically gone. So I can place the blame on them too. And those of you who had a few teenagers, you know what I'm talking about. We did some Section 42. I actually ran the Section 42 program for a developer. Anybody know what Section 42 is?
No.
They're government-sponsored. Well, it used to be Section 8. The government basically gave your tenants the rent was so much, and your tenant paid a third of their income. If they made $100, they paid, $30 in rent, and the government paid the difference. That's the Section 8 program. Most of you guys, if you've experienced it, you've done it in your houses, and it's a Section 8 voucher program, where they get the voucher and they just come to you and give it to you. And most of the Section 8 was project based. So the subsidy stayed with the project, and I've run a whole bunch of those. When the government, it was the '86 tax reform that ended this, basically the voucher or the project based. There's still a little bit of it, but for the most part it was ended. And they came up with this Section 42 program. They basically give you subsidies, tax credits, for you to keep your rents at lower than market rates, and they can be very, very lucrative. I don't think they are as much as they used to be, but if you, anyway, I ran that Section 42 program, renovated a couple thousand units, 2,000 to 3,000. I've done some office and retail. It's not my first love. And so today, almost everything I do is apartments. Anybody familiar with the Walker Building downtown? I renovated that. Took and almost gutted it. If you walk in, you see that big, beautiful ceiling, the plaster ceiling. It was hidden by tile, and somebody had taken a sledgehammer and busted the heck out of the decorative ceiling so that they could hang that polished steel. Anyway, I called my boss one day and I said, well, I got good news and bad news. I said, I figured out what we're going to do to the lobby to make it different, because I found that. And I said, the bad news, it's going to cost $300,000 to bring somebody in from New York to fix it. And then on top of that, we got to have another $100,000 for a chandelier to set the thing off. And he was so excited. I mean, he's almost in tears as I was explaining to him what it was. So it was a lot of fun. So I'm also a realtor. I have been. My claim to fame as a realtor right now, what I tell people is I'm old enough as a realtor to remember when they used to give you a phone book every 2 weeks with the listings in. Most of you guys are looking at me like, I don't even know what the heck that is. It was before computers, and if you were a realtor back then, your multiple listing was a phone book that came out every 2 weeks with all the listings in it, and a little small book that was the sales. Anyway, so today is a really, really exciting time to do multifamily, okay? There are so many factors, and you've heard some of them today. Anthony was spent quite a bit of time talking about some of those. I just want to touch base with a few of them, okay? There is more demand for apartment living right now than there has been in a long, long time, right? For years and years, the American dream is buy a house, right? Move to the suburbs, spend your life on a freeway going back and forth to work, right? I lived in LA for a long time, so I really understand that life on a on a freeway. So there's a number of things. It's more difficult to get a home loan than it used to be. We sometimes joke at the millennials. We talk about how they want to stay in mom and dad's basement. I have a couple of them myself, right? That they want to stay in mom and dad's basement forever. They don't want to go out and buy a house. The truth is there is a lifestyle that they want to be able to move and change that owning a house doesn't allow them to do. But they also have difficulties because they're graduating with more student debt than any of us ever thought of having, which makes it difficult. You know, a new car is so expensive. You graduate, you buy a new car, it puts you out of the ability to buy a home. We have significant population increases, especially here in the Valley, right? You talked about some of the trends of people moving here from California. I just spent 30 minutes on the 405 freeway in Los Angeles trying to go 5 miles the other day. And I was on a bike, and so I got to cheat and go down through the middle of the lanes. I mean, I don't know how people deal with it, but, and all the things, Utah's gonna be a hotbed for people who literally, if they can stand to live there, they're not gonna have any water, right? So they're gonna have to come someplace else. And we've been benefiting from that for the last 10 to 15 years. Plus all the economics that we have going on here, the Silicon Slopes, right? All the high tech, everything that's going on here in the Valley. This, especially here, is a really, really good time for multifamily investors. You look at potentials for inflation. The government keeps spending more money than they have every single year, and what that does is devalue the dollar. Okay, it means that your stocks are worth less. You know, your car is worth less. Your house isn't worth less because there's a limited supply of land, and so it continues to go up. Same thing is true. Real estate is the best hedge of inflation. Some people say gold, right? I don't like gold because I have to buy the gold and then you have to go rent a place to store it, right? And that takes a lot of your return. But real estate is active income. Anyway, it is a really, really good time. Right now, there's a huge, there's more demand than there is supply. And I know we talked about the temporary shift where they weren't renting enough apartments for what they're building. But if you look forward, next year they're not building near as much as they did this year. And so the supply of apartments, it used to be that people built because there was money, not because there was demand. And the lenders aren't letting us do that anymore. You're having to show that there's demand for the product, or they're not letting you build it anymore.
You're talking Utah or nationally on that?
Well, both, but even here in Utah, you look at the supply of apartments, and it is actually slowing down over the net. You can see what's coming online in the next 2 years, and so we should still be very comfortably, 95, 96% occupancy for a number of years. Wage increases. Doing this type of real estate, okay? Has anybody ever run a marathon before? Okay. What was it like? How'd you train for it?
Just gradually going 3 to 5 kilometers and then going further and further and stretching it out so it was a gradual increase.
Okay. Well, it's been a long time. You can tell I don't run anymore, not very much, but
Yeah.
But I remember when I started, and the first 3 weeks is pure physical, right? It's torture as you're out preparing for the marathon. It doesn't take very long before it's no longer physical, right? You go out, you run your first 10 minutes, you're breathing and doing what you're supposed to.
Yeah.
It's literally all mental. It's just saying, I'm going to that next stoplight, or I'm not quitting until I finished my 10 miles and I've mapped it out. And there were days that you'd come back, you'd finish your 10 and you'd think, I could go another 5, right? Because it's no longer physical, it's all mental. And what I'm going to tell you is that when you start to do this type of a deal, you're going to find that it's very much like running a marathon. You start and you keep looking ahead and going, I got a long, long ways to go, and there's so much more to do. I always tell people, this type of investing is not an individual sport. It is very definitely a team game, okay? People can do it. I see people that do this on their own. But I'm going to tell you that the toughest thing you're ever going to do in your life is going to be when you put that deal under contract and you're the only guy. And now you've got to do the due diligence, okay? Walk all the units. Somebody's got to start the mortgage, the application and processing for the mortgage. Somebody else, and if it's you, you're going to do all of it, needs to start the PPM, right? Somebody's got to call the attorney, work through the PPM and all that kind of stuff. And by the way, all those people that you're counting on that have told you along the way that they're going to invest in your deal, now you got to get some information out to them and tell them, hey, we're so excited and all this kind of stuff. And if you're doing it on your own, it's going to be more work than most of you will want to deal with. Anybody else who's done this that wants to confirm that? It's very difficult, isn't it, to get this thing to the finish line? So keep in mind that most of you, I'm going to highly recommend, if you want to get started in this, you team up and find some people that can help you with it, right? Does anybody know what it takes to get a commercial loan? Just a loan itself? What type of thing? What does it take? How much?
12 million.
Okay. Well, it's not necessarily about the money. I'm just looking at the things that they require, right? Your property has to meet cash flow requirements. It has to have a 1.2, 1.25 debt coverage ratio. Okay. If it's a conventional loan, right? You're not doing hard money or something like that. In most cases, the partners have to have net worth equal to the loan. You go borrow $10 million, you better hope you've got $10 million in your house and your other real estate, or you're probably not going to make it, right? They look at credit. You got to have a couple years of experience, right? If you've not done, and your residential flips probably won't count. you got to have some multifamily experience. If you don't have it, you go find a partner that has that. You can take every bit of the information, everything that they need, and put it together and get a loan. Go ahead.
Would a fourplex count as multifamily, or does it have to be bigger?
It may. The answer is probably not, because 4 units and below is residential and 5 and above. But somebody may look at your, it's a lender option, right? So you might have a lender that says, yeah, we don't care. But again, my point is, there's a lot of factors that go into this getting a deal done. And most of us sitting here going, this is my first deal, I don't know where I'm going to come up with the earnest money deposit from, right? We're not going to make it to the end unless we've got some substantial help. How many of you know that you can borrow your earnest money from a partner, right? If you don't have the earnest money, they're pretty substantial, right? Sometimes it's, $20, $30, $50,000, sometimes more. Usually runs in the 1%. So you start doing a big deal, and you're like, where do I come up with that? Well, you can get somebody to put up a piece of that for you. Usually they get their money back in 60 to 90 days. They get a small piece of the deal, and you can work through that. We're going to talk a little bit about the waterfall today, which is literally that's what the investors call the cash flow as it comes and cascades over, and it spreads up into different pieces for different people and stuff like that. So the term waterfall is what a lot of people will use to describe this. Anybody know where that is? Anybody been to Twin Falls, or is it Twin?
I was gonna say, yeah, it looks like Shoshone Falls.
Yeah, it's actually, this is it's Twin Falls up in the Snake River up in Idaho. So if you're going to syndicate, I have students, I have people that are the partners that are like, hey, why don't we just go put something under contract? Okay, just like you do with your, you're taught when you're doing your houses. Hey, let's just go put something under contract. We'll figure the rest of it out on the back end, right? I'm going to tell you that that's going to be very, very difficult to do. You may do it, and you may get to cancel your deal in time to get your earnest money back. In the meantime, you may lay out, quite a bit of money. Your PPM may cost you $15,000. Your due diligence may cost you another $5,000 to $10,000. I mean, you could be into it pretty deep. Yeah, you still get your earnest money back, but you might lose a lot of the other stuff. And so I don't recommend that you start at the point of the waterfall. The waterfall starts way, way up here in the wintertime, right? When the snows start to accumulate. And that's really, you need some significant preparation, in my opinion, if you're going to go in and do this, okay? So partners, let me go back and talk for just a second about when you pick a partner, make sure that you can live with each other, okay? It's easily as important as picking your wife or husband, okay? Because in some cases you're going to spend more time with them, right? You're certainly going to have just as many disagreements, if not more, right? And so I always look at it, it's okay if we yell and scream at each other, okay? You're an idiot, okay? But just like somewhere you were probably taught, never go to bed mad at your wife, always kneel down and say your prayers or whatever it is you do so that, you guys can go to bed together. You need to fix those with your partners pretty quickly also, because they're your lifeblood. I've had some really, really good partners. And I just blew up a deal. I was flying into Dallas every month for almost a year to raise money for some of these deals we were working with. And he was a good friend, and I'd known him because we used to teach together. But he had to have complete control. And even that would be marginally okay if he really knew what he was doing, but he didn't. So he was making decisions and taking us off, Everybody else, he was cracking the whip. You guys got to have this, this, and this. And the pieces that we gave to him never came back in on time. Well, I could see the writing on the wall, and I said, man, life is too short to hate going to work with a partner that you can't stand, okay? If any of you have ever been in a bad marriage, you might know what I'm talking about too. So, but which you guys all know why divorce costs so much money. They're worth it. Anyway, again, you got to start thinking about preparing for this thing. I believe that you need to have your money raised, or commitments to your money. You can't have it completely raised, but I think you should have significant commitments from a number of people that said we're going to do this. In fact, the rule of thumb is that you need about 1.5 times what you really think you're going to need. Okay. Typically, what I've done is we'll go for about 6 months, because I know that I'm not going to get people to go too far beyond that. You know what? If I put them on hold for too much longer than that. So when we're at about 5 to 6 months, then I kind of add up what commitments we've got. That tells me how much money I've got, and we go find a project that will fit that requirement. It's easy for me to do because I've been doing this for so long that finding deals, you know, it's like walking down the street and kicking a brown paper bag kind of thing, and $1 million rolls out. So it's easy for me to go and find those deals. And it's not difficult either. You know, with a little bit of training, you guys can figure out how to find those deals. But I'm going to tell you the harder part, it's always been the hardest part for me, is finding the money to back up the deal before you get there. Would you agree? Don't.
Yeah.
Deals are a dime a dozen.
It's
Maybe.
tougher to find deals. Better at it.
Well, I'll show you a little bit one of the reasons why they're easier for me is because I don't buy anything to hold necessarily. Everything I do is a value play, and so I can close on what most of you would think is a crappy deal, but if I can raise the rent enough, I make it into a really solid deal, and that's how I'm able to get those deals to, you know, it's really about, you don't go looking for this deal, you go looking for something that I can change and convert into what I need it to be, so that I can raise the money I need to. So these are some pretty basic things, but they're really, really important, right? Where do you start? You're going to start with people you know. Okay? Right here, RIA clubs. For a long, long time, I was traveling, I was so busy that I didn't make it to the RIA clubs like I should. I see people that I met 2 or 3 years ago that know everybody here, and I come about every 3rd month or so when I find time, and I really miss that. And I'm going to tell you that I never ever come to one of these events, whether it's a luncheon, whether it's, you know, it doesn't matter, but I always meet somebody that I think I can use, and I used to be, you know, I want to talk to everybody and trade cards and all that kind of stuff. I really 2 or 3 people at a time, and just by that, every time I come to one of these luncheons, I'm going to learn something that I didn't know, and I'm going to and I'm going to meet a couple of people that I think I can help and work through. So these are really, really valuable. One of the problems that most people have with these, and I love this RIA group, because you sign up the list and they send it out to you, right? But the problem is, most of you put it in your email box somewhere, and that's where it stays. Right? It needs to go. I don't care what contact system you use. I personally use Gmail because it's just so easy. I have an email account that's just set up for this, and it goes onto my my email account, categorized by where I met you, little note, the date I met you, when I met you. Those are really important, by the way. If the SEC comes calling with a cease and desist order, they're going to want to know when you met these people, so that they make sure that if I'm here networking today, I always tell people I can talk to you today, I can take your business card, okay? But I can't introduce you to any deals that I do, okay? Technically tomorrow morning, I can introduce you to a deal. I can call you up on the phone, see how you're doing. We can talk, and that provides me a significant relationship, typically. And 3 attorneys that I've worked with have all confirmed that. But then they said the caveat is that you also have to make sure that I don't introduce anybody I meet today. I can't introduce you to a deal that I have today. I could put you in a deal that I have in the future, but I can't put you into a deal that I have today. So again, keeping track of those dates, when you met them, where you met them, it's all really, really important to being able to do this successfully. Partners, you can target market to professionals, okay? You think about who has money. We think of doctors, lawyers, business people, right? I did this one time. I downloaded the complete list. I went to an insurance company and I downloaded the complete list of all the doctors that are practicing in Salt Lake City or Salt Lake County. It took me 30 minutes, okay? And I got the complete list that I can start to network with them, okay? Same thing with the attorneys. You can go to Utah Bar Association, you download their whole list and start to network with them. So there's some significant ways besides just coming to RIA clubs and stuff like that. You can start to market to professionals. Retirement money. How many of you guys, and most of you probably know at this point, but show me by hands, how many of you know that you can take your IRA and put it into real estate investing? Okay, good. Most of you have been, I'm going to tell you that probably 70% of the money you're going to raise is going to come from that. So if you don't know the rules on how to deal with retirement money, you probably should get somewhat familiar with it, because they're very specific on what you can and can't do. And I would feel really bad if I had somebody come to me with their hard-earned retirement money and I gave them bad advice and told them you can do this and put it into my deal, and it turned out that they lost their retirement status. Go ahead.
If they just have a standard 401k and they don't have a vehicle currently to put money into real estate, who do you guide them to do that or suggest?
So I'm going to tell you, you probably don't want to move it into an IRA, because this type of real estate will subject them to taxes within their IRA. It's UBIT, and what's the other one? It's unaffiliated debt finance, I think, UDIT. And if so, your IRA comes through a trust. It follows the trust laws, and those you do have to pay tax on debt finance business. But in a 401k, it's generally exempt. So that's the first thing, is make sure that whatever you do, put it into a 401k, a solo 401k, not into a solo IRA or self-directed IRA. Okay. There's a couple of big companies. Equity Trust is out here today. You should stop and talk to him. I can't remember his name. And Pensco Trust, I used to use those two all the time. The reason I used those for my clients was because that they have the money that's held. You know, you think they just open a separate bank account for each one of us. They don't. It's all one big master account. And there's a couple of them that those bank accounts are FDIC insured. So if you're putting your money in there and the guy decides that he's going to cash out and go to Mexico, which happened here in Utah about 5-6 years ago, he just cashed out and took everybody's money, and he's now serving time for it. But if it was in an insured account, you wouldn't have to worry about that. So I look for some of the big guys. There's also some places that you can do that have fees. I personally like the it's a what do they call it? A QRP, because it's kind of a combination of you can use part of it as your IRA, you can use part of it, you can mix them all in together, and it's checkable. So for some of you, that's going to be a dangerous thing, right? Because you can write a check, and you can write a check on something that you shouldn't be writing the check for. So, but But if you're just looking to be able to quickly write an earnest money deposit check or something, and you understand the rules, it's really nice to have it checkable. And if any of you guys know Jeff Brelio, he does those here. So,
What does the QRP mean?
Qualified Retirement Plan.
Okay.
Angel investors, you go online, they're all over the place online. And if you're looking for somebody that can loan you an earnest money deposit, or maybe you've got a significant project, right? More than likely, they're going to look for somebody who's got pretty significant experience. Before you go approach an angel, you might want to have a partner that's had some experience. So, but they're there. This is one that not very many people think of, but here in Salt Lake, there's commercial transactions that happen all the time. And there's buyers of those and there's sellers of those, okay? Do you think the seller might not have some money that you might want to earn some money on? You can go to your title company and they can get you a list of every commercial transaction or every apartment or whatever you want to do from last year or however long you want to do it, and then find a way to network with those people. I mean, I'm just telling you, we're not just talking about talking to your neighbors and friends, right? There's an infinite way, and this is not even an all-encompassing list, but there's a lot of ways that you can meet people who have money that want to fund your deals, okay? Same thing with residential investors. You can get your realtor to do a list off of the MLS of every home that sold twice in the last 6 months, or twice in a 6-month period last year, right? They're almost always flips, right? They bought it on the MLS, they sold it on the MLS. You can also search for stuff that's recently flipped or recently rehabbed or whatever. And you're gonna have a whole big list of investors. And if you just incorporate that presentation that Anthony started with earlier, right? You're up, you're down, you're up, you're down. Would you like to even that out a little bit? Take and throw me a little bit of money once in a while, you know, in something active, right? Or passive. So the way that you're going to do this, you've got these list of investors, and you have to figure out how you're going to approach them. I brought you. If you have chance after, you're welcome. But I have a bunch of different. I call them tools of the trade, right? These are properties that I've looked at, but they're just the basic financials that I can sit down with somebody and say, here, this is kind of what we're looking at. These are more involved business plans and that type of thing. But you're going to have to put together some sort of a pitch that you can go talk to these people with, okay? And you don't even have to have a property to do it, right? If you have a property that you fell in love with, but you never had the earnest money deposit, or you didn't have the courage to go do it or whatever else, but you found a good property, at least it gets you active looking at properties on a regular basis and evaluating them, and you pick one or two and you take it to the point where you've got a business plan that you could sit down and hold, you know, people can hold, touch, feel. Most of the time that I've done this, I have not had a property in mind, okay? We have written a business plan. We've used a couple of fictitious properties to illustrate kind of basic rates of return if you're going to do a value play or if you're going to do a long-term hold. So the pitch is really, really important. The business plan, whatever it is that you want to call it, you're going to need information about the properties. Just basic, you get that right off LoopNet, right? You look at what the brokers put together. A lot of the information is going to go right back into our package, okay? You're going to look for information about the city, state, employers, employment rates. You know, again, you guys just watched Anthony, he gave you all sorts of information about Salt Lake City and what's going on here, population growth, okay? Years ago, I was working for a property management company, and after a while, they sent me out to start to talk to, well, every time we got a request for a proposal, somebody said, hey, we're thinking about changing management companies. They sent me out. Sometimes it was jump on a plane tomorrow, you're going to Phoenix. You got 2 days to come back and produce this thing. And sometimes there were 30, 40 pages. So I didn't have time to go do all the research. And this was back before the internet. which it's easier to research it now than it used to be, I'd start at the Chamber of Commerce. $10, I got a book, and it had every bit of information that was positive about city, state, whatever. And I wrote one of these business plans. I wrote all the information about Denver probably in 30 minutes because I read the package with all the information dictated into my computer, and then it took me another half an hour to edit the bad grammar and stuff like that. But it's not that hard to gather this kind of information. It's regional areas. So usually when you find with a fix and flip, if you've done business plans for your fix and flips, they just want to know about the property, right? Nobody cares because we're not going to be in there more than 6 months. We don't really care what's taking place with the neighborhood and that type of thing. But when you're dealing with long-term properties, it's very important. People want to see that you did your due diligence. So, you know, I start with the state. I go to the local or the county numbers or whatever, and then I end up with the local. What's going on in that immediate neighborhood. Okay, we want some current financial information on the property. Again, for the most part, you can get most of that from the broker package, off of LoopNet, all that kind of stuff. But I need to be able to show income and expenses to a cap rate. And sometimes that cap rate's not going to look very good based on real numbers. And I always tell people, I get all the current information, but for the most part, I don't care about it, because what I care about is how I'm going to run it. Because I'm buying this because I'm going to run it differently than most of the other people are. And so your pro forma, to me, is a lot more valuable. You may talk to somebody else who says, no, you got to have real numbers or whatever. But for me, it's how I'm going to run it, because that's what I'm going to present to these people. Pictures, they tell 1,000 words. Throw a few pictures in there. Some stuff about how you're going to improve it. If you've done a flip, we're gonna put granite counters in this one, stainless. Get some pictures of some nice kitchens, or this is what our plan to do. This really sell this, because that's really what that's when people get really excited about this. So, and then again, your financial projections, and lastly, a little bit of information about you, right? I really believe this, right? Nobody invests money with somebody that they don't know and respect, okay? It doesn't matter how good the deal is, right? Only a fool will go and invest money in a deal and they don't know anything about the people. I honestly believe that information about you is more important than all the information about the deal. So, and if it's not it's not a great resume, get together with somebody else, talk about your schooling, there's a lot of things that you can do to put that together, okay? In addition, you could start with network meetings, right? You put together a PowerPoint, similar to this. Believe it or not, Anthony's is educational, but he's also looking to get some of you guys to invest with him, and he'll give you that opportunity later. So you find places that you can present your PowerPoint, have 4 or 5 of them ready, okay? General information about commercial real estate investing, right? It gets people excited. And information about self-directed retirement accounts. This is so big, because everybody here raised their hand and said, yeah, we know what they are. But I find that even though it's been 10, 15 years that I've been talking about self-directed retirement accounts, when I go out into the real world, there's probably 50 to 60% of the people who've never heard of it. And so you can teach them a lot about self-directed retirement accounts. By the way, this kind of stuff you can post. You probably heard that you can't put your pitch out on the internet, right? On Facebook or anything like that. This kind of stuff you can, right? It's pure educational, and as long as it's not a rah-rah piece that gets people excited about investing, it's just educational about how to run your self-directed retirement account, you can publish that, at least according to my attorney, that you can do that. Basic rates of return for commercial real estate. My attorney says it's the view from 30,000 feet, right? I don't want to take in a general publication, I don't want to put a specific deal that we just did that made 35% to my investors, right? That'll get me in trouble. But what I can do is say, look, this is the type of deal that we generally invest in. And most of my investors are in this range, and I'm really careful to not make it too big, right? But if I tell people between 12 and 18%, and I'm looking for, some sort of a value play that I can raise the rent $300 a month and sell it in a year and a half, get your money back to you. That's the view from 30,000 feet, and you got to be careful how you put that in there. But again, you got to have something that gets them excited. You want to tell them how to get involved, right? Then be around to answer any questions about the product. I told you I was flying into Dallas every month, and every other week we had, if I wasn't in Dallas, on the other week we did webinars, okay? And I worked with the guy that ran the RIA, one of the RIA clubs down in Dallas, and so he knew. I mean, it'd be like working with Jeff Deering, right? He knows everybody in the in the Salt Lake Valley, because at one point or another they've all come and he's got the huge list of all of them. So he was just calling up people, inviting them, saying, hey, I've got this crazy guy from Utah that's going to come in. He's going to talk to us about apartments, and by the way, he's done 80,000 units, and we'd get 15, 20 people every Saturday, or when I was in there. I'd spend 45 minutes talking, turn around and jump on a plane and come home. But we closed 1 to 2 people every single time that we did it. So it was, this is where most of the best, getting to, whether it's a lunch meeting, if you get people to go to lunch with you and take your tablet with you, you can flip through the tablet, or if you can put people, it's obviously more effective to put them into a room. You only have to buy bottles of water instead of a $20 lunch. But you get, this is where most of it's going to come. You can do the PowerPoint presentations online, but I would say probably 5 to 1. We got people from personal rather than webinars. Go ahead.
The people that invest in the deals you put together have to be accredited investors or not?
No, well, it depends on how you structure it. And it's, I guess the real answer I should be telling you is I'm not an attorney, and so.
Based on your experience.
But no, and we're going to talk about it in a minute, but a typical 506D, or 506B, sorry, allows 35 non-accredited but experienced investors. Okay, and so, and an unlimited number of accredited investors. We're going to talk, if some of you don't know what that is, we're going to talk about it a little bit. These are the waterfall points. This is what you're going to put into your pitch, okay? Number one, your asset management fee. Most of you, maybe you don't know, but you're going to get paid monthly before everybody else does for an asset management fee. I personally, if I have a deal that's not putting out a lot of cash flow, I forego taking it. I take it out at the end, but in my documents, I have the right to take that out first before anybody else gets paid. And it's not significant. It's probably 2 to 3% of the gross cash flow. It's not off the net though. It's off the gross. Whatever dollars collected, I get a percent of that. This one is the most exciting for most of you. How many of you like to get paid? Go ahead.
Are commissions included in the asset management fee?
Commissions.
Real estate commissions, if they're available?
You mean if you're a broker, I
Right.
take, no, it's not part of the asset management fee. I always take that separately. I'm a broker myself.
Right.
I've paid my Utah real estate dues for 10, 15 years and really haven't done any transactions except to buy a couple things for my kids that, I didn't get paid for. They took the commission. So, but I do that because the commissions are significant. If you're a broker, if you're an agent, they're $70,000 to $100,000 easily up front when you buy a deal. In addition, the acquisition fee is typically going to be 2 to 3, sometimes 4% of the deal. And you're going to structure these depending on what the deal allows you to do, right? And so it's just like wholesaling. You make sure that your investor gets a reasonable rate of return, and for the most part, you can take whatever's left over. But yeah, we get paid up front to buy, a small piece to buy these. Yes, sir.
Sorry to interrupt. Are you going to touch on what you consider a reasonable rate of return is, like what you try to get your investors at some point?
Yeah, so I look at every deal I look at. My target is 40% if I sold it in the first year. So the deal's got to return 40%. That means that I can give, and it's between 30 and 40. Okay, I can squeak by with a 30% deal. But the theory is I'm going to take half of it, and my partners need about 15%. If they're going to take their money out of the stock market, they need about 15% to justify doing that. Because face it, I'm riskier than Dean Witter. I don't know why, look at me, I'm an honest guy, right?
That's arguable, though, really.
I know it is, and that's why
that's really arguable.
That's why I'm qualifying that. But most people will be very comfortable if they thought they could get 10. The truth is they're only getting 6, right? And sometimes 5.
Who gets that 5 or 6?
If you've got your money in the stock market
Oh,
right
yeah,
now,
okay.
they're telling you 10.
Yeah.
That's what I learned in college. But it's really 6 and 5. But I set my target. I try to get my investor. If I can't reasonably comfortable that I can get a deal at 15 for my investors, I'm probably going to walk away from that. And that's with me taking half of it.
Are you giving them any sort of pref throughout the deal, or?
That's what that is right there. Preferred return.
Gotcha.
Yep.
Okay, so that's your monthly to your LP.
Mm-hmm.
Okay, got it.
So the first piece of cash that comes out is a preferred rate of return to the investors. Okay, I get my asset management fee up front. What's left over after we pay them? I usually agree to pay them a rate of return on the money they invested. So it's 3%, it's 5%, it's 7%, it's 10%. Okay, it's preferred, which means it's not guaranteed, but it means it's the first money that comes out. If you end up owing them, so you agree to pay them 7 and you only pay them 5 in the first year, next year you got to pay 9 to get caught up. And if you go all the way to the end when you sell it, your preferred return is going to come off first before you split up the profits. And so it's like a guaranteed return. You never want to call it a guaranteed return, but that's what it ends up being, is a preferred return. Now, if it's a cash flow type property, something that I'm going to hold for a long period of time, most people are looking for 5 to 7. You're going to have a hard time dealing with that in Utah right now. It's really, really difficult to get a 7% preferred in Utah because cap rates are so low. But maybe you just promise them 7 and deliver 4, and then give them because in Utah you're probably going to make a big windfall at the end. Because cap rates are so low, the value of the property goes sky high. After that, after the preferred return, then you're going to split the cash flow with them. And mine is usually about 70% to them and 30% to me. You're saying, man, you're cheating yourself on the cash flow. But I'm really not, because if you add this in up at the top, plus whatever it still works out to be about 50% to me. And you'll see this all the time. People talk about a 70-30 deal or a 60-40 deal or whatever, where they're giving a lion's share of the cash flow to the limited partners. But I don't ever give up on the back end. I never give up more than, I always keep 50% for me, because that's where all the work is for me. That's where, and so I'm happy to give them a little bit more cash flow. And then after that, I get my percentage of what's left over. If it's 30%, 20% of the cash flow that comes across. You want to talk about split of tax benefits? There are some tax benefits that are available. Get a good program that'll calculate those into your rate of return if you want. It'll sometimes boost your return.
What's a good program that you use?
Well, I wrote mine. So, it looks like that. So, then the last thing is the split of profits on the sale, right? And this again, for me, I'm hard, fast. I do so much work for these. I'm willing to wait till the end to get my money, but I want half of the proceeds of the deal. Besides, it really is our expertise that's adding that value, because I'm not just holding stuff waiting for it to go up in value. Everything I do is forced appreciation. Cash on cash return. You sell this a little higher cap rate. I'm going to figure that into my reversionary cap rate on the way back out. So did that answer your question?
Right, so specifically in this market where they're 4%, so you can only do the value play by, that's all that's available because of that, so you can't be leveraged with long-term interest rates, you've just got to be cash in, cash out.
Yeah, if my project's paying me 5 and I'm paying 5% out the back, where's my cash flow? Right? And so you can go someplace and find an 8 cap that's something paying you 8 and finance it at 5, because mortgage interest rates are the same all over the country. So I'd go to Mississippi, Oklahoma, and buy 8, 9 caps and provide monthly cash flow. I can't buy those in Salt Lake City, so the only way I can make money in Salt Lake City is to have the project go up in value while I hold it. And that comes to forced appreciation. And there's a rule of thumb, Anthony talked about it earlier, okay? For every $1 I raise my rent at an 8 cap, it's $150 a month, or $150 of added value. At a 6 cap, it's $200 of added value. And if you're in a 5 cap market, it's $240. And so if you're going to go spend money, you're going to spend $15,000 to fix a unit up in 2 different markets, and you're going to raise the rent the same $200 a month. Do you want to do that in a 5 cap market or in an 8 cap market? In a 5 cap. And so that's why Salt Lake is a value play market. Okay? You're getting more benefit from raising the rents for what you spend, right? But you're not getting any cash flow. That answer the question, hopefully? Okay. We're going to talk really quickly about Reg D. I think I got about 3 minutes left. So some basic things with Reg D. These are securities and exchange rules. Most of you are going to do 506B. There's a 504 and a 505, but not very many of your attorneys they're small deals, and most of your attorneys are not going to recommend you do them. The 506 jumps over all state laws. If you do a 505, you have to comply with the federal regulations, and you have to apply for each state for every investor you have and where your property is, and it becomes quite difficult. So most people just skip to 506B. There's no public advertising whatsoever, right? You can't put a radio ad in, call me, I've got this great deal. You can't put it on Facebook, okay? You can't call people on the phone, say, hey, come, I've got this great deal. You can call them and invite them to a seminar, right, where you're going to teach them about self-directed IRAs. Accredited investors, if most of you probably know this, it's $200,000 a year of income for the last 2 years, or if it's a husband and wife, it's $300,000 between the two of them, or it's $1 million of net assets, and that's net of their home. So they've got to have significant assets, and they're accredited investors. You can put sophisticated investors. I would say everybody who comes to a RIA club meeting is a sophisticated investor. Even if your CPA doesn't do real estate, he just does taxes, okay, he's probably a sophisticated investor. Business people, they would consider them sophisticated investors, but you can't take Widow Jones' last $50,000 and put it into a deal, because they'll come down hard on you, okay? You're going to have to do a PPM, which is called it's a disclosure document. I have one, oh, here it is. Okay, they look, depending on what you do, It consists of your business plan, and it consists of your operating agreement, and it's a disclosure document. Now, this disclosure document, the purpose of it is there's an anti-fraud provision. So anybody that's sophisticated has to have a copy of this disclosure. You're accredited, don't necessarily have to, but it's a really good idea to have this. So what this is, I write a business plan, and it's everything positive about my deal, right? To convince you to come join my deal. And then I give that to my attorney, and he shreds it and writes everything possible he can think of why you shouldn't invest in my deal, right? Now, you think that's ridiculous. Why do you do that? Well, attorneys are the fastest way to screw up a good deal in the first place, and anybody who's done a few knows that. But when your client, your investor says, "Hey, I just want to check with my attorney," you might as well check the box and go move on. But anyway, so what happens is your investor's suing you because the deal went bad, and he's sitting in court testifying, and he says, "You didn't know that this deal could go bad?" "No, nobody told me the thing like that." And my attorney gets to get up and he says, "Is this your signature?" "Yes." "Look at page 13, look at page 17, look, you signed that, didn't you?" "Yeah." "Okay, so you were told." And it may not keep you from going to jail, but it'll certainly slow down the process quite a bit. You'll have 2 or 3 years of freedom before you. No, I'm just kidding. Right? Anyway, that's what a PPM is, right? You got to be able to answer questions about the investment. This one here, 506C, is new. Well, it's within the last 4 or 5 years. It's called crowdfunding. If you agree to deal only with accredited investors and you won't let any sophisticated investors in your deal, you can now publicly advertise for your deals. Okay, you have to go through 506C.
Sorry,
crowdfunding.
I missed it.
Okay, and you can do unlimited advertising anywhere you want. But you can only let accredited investors in. The caveat to this that makes it difficult is that in the other one, I just have to get them to sign a document that says that they're accredited. I don't have to go and search anything. But this one I have to prove that they are, meaning their CPA has to write me a letter, or I have to see tax returns or something like that. In the past, we've decided not to do these because I didn't think that the investors that we had were going to want to give up their tax returns. So.
Isn't accreditation self-proclaimed?
It is until you do a 506C, and then they have to prove it to you.
Okay.
Okay? Who knows what the Howie test is? Anybody ever heard of it? So, years ago, this was 1947, I believe, and there was a orange grove company. They were manufacturing oranges. No, they were growing them down in Orlando. And people were coming out after the war. They're taking their families down to Florida, and they're stopping at this restaurant where they also had fresh orange juice, and they wandered through the orange groves, and everybody said, "Oh my gosh, this is so wonderful, I want to buy a piece of this." And the Howie group decided that they came up with an idea. They knew they couldn't sell shares of the company without doing SEC work. So they said, what if we sell the land? We'll sell you 10 trees, a little patch of land that's got 10 trees on it. We'll take care of everything for you. We'll send you a box of oranges at Christmas time. And then, whatever, if there's any money left over, we'll send you your return on the money you invested. Well, some people looked at this as an investment, and they ended up going to the SEC, who sued Howie Corp. So this is a U.S. Supreme Court ruling from 1947. It's called SEC versus Howie. And this is really, really important because this is what determines whether you are an investment scheme or whether it's a partnership. Okay, so basically the SEC ruled that Howie Corp was an investment scheme because it was all passive. These people gave their money to Howie, and Howie did all the work. So anytime, whether it's loans, it doesn't matter what it is, if somebody else is doing all the work and you're taking the money, it's a passive investment for them, and you absolutely have to follow the SEC rules and regulations, okay? even if it's a house, if it's a single-family house that you're flipping. But what came of this is, if your partners are active, they have voting rights, they make decisions, then according to the SEC and the Supreme Court, it's not an investment, and it doesn't follow under the rules of the Securities and Exchange Commission. So a word to the wise, I'm not going to guarantee that this will keep you out of trouble, but anytime you're doing small deals, make sure that everybody has active involvement in that deal. Because at least when they knock on your door with the cease and desist, you can say, hey, I was following the rules, I believed I was. Everybody has voting shares, it's all legitimate, right? And my attorneys confirmed that a couple of times. You gotta get a good attorney, SEC attorneys, and it can't just be a real estate attorney. They have to specialize in securities and exchange laws. And you have to listen to them, okay? This is one of those areas that, you really need to take your attorney's advice, because it's really easy to get off track if you don't. So, I'm over time by a couple of minutes, I apologize. Just want to thank you guys so much for coming out, giving me a few minutes. And let me know, does anybody have any questions? I mean, you're all free to go if you want to. We got a half an hour probably before the next group comes in, but anybody have any other questions? Go ahead.